Right, so welcome everyone. Welcome Adele, welcome Barry to this introductory lecture about the Consolidated Statement of Profit and Loss. So my name is Neil Cochrane. I'm one of the trainers here at Osborne Training, and I'm going to be talking to you in this module about what, first of all, consolidation is and how it affects the profit and loss. So let's take a look at the aims for this unit. So the aims for this unit that we have are, first and foremost, we need to understand what consolidation is. Because a lot of times the students tend to be a bit confused by what actually consolidation means. And also the effects on the financial statements. Now we are only going to be looking at the statement of profit and loss in this introductory lecture, but it also affects the statement of financial position as well. Alright, so the SPL, or Statement of Profit and Loss, so you often hear me say SPL just to kind of shorten it down, is a nice introduction to consolidations because there's not as many adjustments that need to be made as we will see later in the Statement of Financial Position. Alright, so that's our first goal. Our second goal is to understand how to complete a simple consolidated Statement of Profit and Loss. So we're going to focus on just getting you the basics, and then in later sessions we can work on getting you used to the adjustments that are involved, because that's where most of the points on these kind of exams lie, are in the adjustments. Because as you'll see, if there's not really any adjustments, consolidated statement of profit and loss is not very difficult. So good for you, I think. You can kind of relax a bit and say, okay, once you get the statement of profit and loss done, then you can move on to the more difficult statement of financial position. So let's start by looking at combination and consolidation. So this comes from the International Financial Reporting Standards, so IFRS. So the two international financial reporting standards that talk about this are IFRS 3 and IFRS 10. So it's very important that you know about the International Financial Reporting Standards and that you get the ideas in your head. Because a lot of times students focus exclusively on the mathematics and don't worry much about theory. Now you're not going to be very successful if you do that. So if you know the idea behind the International Financial Reporting Standard, it makes it so much easier to get to the calculations. So make sure you have a well-balanced study method here. So don't just look at the calculations. Focus on learning about the International Financial Reporting Standards. Alright, so in your course notes and tutorial guides, there's all you need to know about these. And so I really like international accounting and financial reporting standards, so I am kind of a geek and I do read them just for fun. Well, not really for fun, for work. Alright, but you need to get into the habit of seeing these as helpful guides to help you as an accountant create financial statements. So they're not just here to make your life miserable, they're here to actually help you. Alright? So let's look at IFRS 3. So IFRS 3 talks about what a business combination is. And it says here that a business combination is a transaction or other event. So it doesn't necessarily have to be a purchase. There can be other things that happen as well. We'll go into those in later units. So basically, the acquirer, so the person who gets it, so the business, right, obtains control. So control and ownership, we have to be careful. There is a bit of a difference, right, of one or more businesses. Right? So if you look at these multinational corporations, they have a lot of what we see as called subsidiaries. Right? So they might have subsidiaries throughout the world. And business combinations, especially in these days and ages, happen more and more often. Alright, so we don't see many small companies as much anymore. We see small companies being bought out by larger companies. So if you look at, for example, Google, Google purchases these kind of small independent technology companies so that they can bring the knowledge and skill sets together. So Google is a massive corporation, and has a lot of subsidiaries. Alright, so all of this would be dealt with under IFRS 3 and 10. Alright, so IFRS 3 says that it talks about control. IFRS 10 discusses what control actually means. So the easiest one is that if you've got 50% of the voting rights in the company, you've got control. But that's not the only thing. So a lot of students say, if I ask them, how do you gain control of the business? They say, well, you get 50% or more of the shares. Yes, all right, but that's not necessarily the case. So some companies can have control of the business, but not have 50% of the voting rights. So the other ways that you can gain control that IFRS 10 talks about is if you have the right to appoint, reassign, or remove key management personnel. All right, so if you can say that I don't like the president of this company, they're gone, then you have control of that business. It doesn't matter how many voting shares that you have. You exert control over that business. Now, the next thing that IFRS 10 says is when you have the right to appoint or remove another entity that directs relevant activities. So not just necessarily the top branch, but let's say you've got, you can remove managers, you can remove things like that. Anything that deals with the business, if you can say this person's gone or I want to close this activity, right, then you have exerted control over the business. And you have the next thing that it says is you have the right to direct the investee. So the investee is the company, right? So to enter into transactions. So, for example, if you're a company and you have 30% share in a company, but that exerts, you can say to that company, I want us to start producing cars. And if they say, okay, we have to do that because you said so, you have control. And finally, if you just exert control over the entity, if you have a strong, presence of that company, you exert control over it. Right? So take a look at the tutorial guide and course notes because they give you more specific examples. All right, but this is just, as I said, kind of an introduction to that. So is there any questions before we move on about combination and control under IFRS 3 and 10? Okay, Adele's fine. How about you, Barry? How are you doing? Okay, good. So moving on from that, we have to talk about when you own a company, all right, you might not own 100%. If you own 100%, that's 100%. But a lot of times you're not going to own 100%. So a lot of times you're going to have what is known as a non-controlling interest. So this is the percentage of the business that you do not own. So, for example, if you own 80% of the voting rights of a company, 20% would be what's known as the NCI. Okay, Adele's got a question. Let's see what she has. It's sometimes called the minority interest, yes? All right. Because we just have to remember, under the IFRS, so under the International Financial Reporting Standards, it's called the non-controlling interest. All right. The minority interest is what we use a lot of times in everyday speech. All right. But if we're necessarily talking about the IFRS, we have to be very specific and use their terms. All right. But for example, in the UK, we do say minority interest, and a lot of times, if you watch the news, they do say minority interest. But you do need to be careful because if you work for a company that uses IFRS, you need to use the terminology. But if that's the terminology that your company is allowed to use, you can also call it a minority interest. Right? It's kind of a terms thing. So, for example, if you look under the US, it's called something different as well. So each standard that you use has a different way of saying it, but it means the same. Right? So minority interest. All right. Very good question. All right. So I can see that you're probably working in financial reporting. Very good. So what happens with the minority interest or the non-controlling interest is basically the profit that that company makes, you have to give them a percentage of it because they technically own a percentage of the company. So, for example, if the company made £10,000 in profit and there's a 20% non-controlling interest, 2,000 of that profit would have to go to the non-controlling interest and we would keep the 8,000 in profit. Right? So that's, when we look at a consolidation, you see how it's done. So after we determine the profit of the company, of the consolidated company, we then distribute the profit to us and to the non-controlling interest. Okay, so let's take a look at the format of this. So the format of the SPL is, it's quite simple. So basically all we do is we cross-cast. So you add things up together. So if we've got two companies, we have, of course, the revenue of the company. You simply add the parent, and then you add the subsidiary. Now here you can see I've put this in. We're going to look at this in later sessions. You have to get rid of any intercompany sales. Now the reason behind this is quite simple. So if we think of the business as a circle, all right? So two companies, so we've got two smaller circles. We've combined them to make a larger circle. So if you're selling to a company you own, that's not really a sale, is it? All right, because you're just transferring funds, you're just transferring things between the company. All right, so anything that's within this bubble of the company is what is known as intercompany transactions, and we eliminate that because if we show, for example, if we sell, company A sells to company B, and let's say that that's £10,000, that's not actually really a sale according to the International Financial Reporting Standards. That's just basically you're just transferring back and forth. So be very careful about that. We'll look at that later about what you do. So you just simply subtract any intercompany sales because it's not outside the business. We only are worried about the revenue that comes from outside the business. Now we get to the more complicated part here when we talk about cost of sales. So hopefully you remember from your earlier studies that cost of sales is opening inventory plus purchases minus closing inventory. Right? So we basically take the opening inventory of the parent and the subsidiary. We add, of course, the purchases of the parent and subsidiary. But, as you can see here, once again, we need to get rid of intercompany purchases because it's not from outside that bubble. Right? So it's sitting there. So you're just purchasing in the bubble. It's not technically a purchase. It's just a transfer, really. All right? And then, in the end, we have our closing inventory, so we add our parent and our subsidiary together, all right? And then we come to the fun parts. We have intercompany unrealized profits, all right? Or it's called in the standards a provision for unrealized profits, all right? So we'll get to that later, but basically, if you sell something, you make a profit, don't you? But if you've sold something to your subsidiary, you've not really made a profit, so you need to get rid of it. All right? Now, students tend to struggle with this, so we're going to have a specific session on this later on. Okay? Don't worry too much about it now, as this is only an introduction. So, after we get our revenue and we take our cost of sales, we deduct the cost of sales from the revenue to give us our gross profits. All right? So just like we've done before. And the gross profit, we take the parent and the subsidiary, and once again, any unrealized profit is then deducted because we've not made a profit. We basically moved money from one account to another account. So it's not really a profit. So now we come to our expenses. So on the exam, we have the typical expenses, so distribution and admin, you simply add together. All right, and this gives us what is known as our profit or loss from operation. Right? And you can just add the parents and subsidiary together. Finance costs, once again, simply just add them together. And profit, that gives us our profit and loss before tax. So this is where we get our profit ratio. So, for example, if the subsidiary comes here, this is where it comes in. So then we take away our tax, and then we get our profit and loss for the year. And we say profit and loss for the year from continuing operations. Right? That's how we should technically say it. But you can see it's just a lot of adding, really. Right? And then just a couple of small adjustments that need to be done. Okay? So are there any questions before we move on to look at an example of just a simple statement of profit and loss question? Okay, Adele's fine. What you doing? You all right there? Okay, good. So let's look at an example. All right. So, let's look at what after we find the profit, we have to do the attributable. All right. So this is also where students also forget a lot to do this because that profit is not all for the main company. All right. We have to worry about the non-controlling interest as well. So we say profit attributable to, and we call this the equity holders of the parent. Right. So kind of simplified owners, but as you know, there's certain words that we have to use under International Financial Reporting Standards. So we take the parent's profit plus the profit of any wholly owned subsidiary, so 100%, and then a share of any partly owned businesses. All right? And then we also take the non-controlling interest. All right? Has to get a share of the subsidiary's profits. Right? Not the total profit. Don't make that mistake. Right? It's not the total profit. So we're going to have to look at the profit of the subsidiary and then give the non-controlling interest their share of that profit. Okay? So let's take a look at an example. So I've created this short little example. We've got a company called Celia Limited, and they bought 90% of the shares in Call Limited on the 1st of January 29. So here you can see we have the revenue, we have the cost of sales, we have gross profit, distribution, admin, profit before tax, profit per year from continuing operations. So let's go back and look at how we do this. If you remember how we do this, we simply cross-cast. Now there's no adjustments in this one because it's introductory. So all we basically do is we can just add these amounts together. Simple, right? So if we just do that, we add all these together, that will give us our profit for the whole, so the parent and the subsidiary. Okay? So we just add that, and that, and that. So it's quite, I always say it's always good to start with this, well, you should always start with a statement of profit and loss, because it's a nice little way to get your mind working, right? Because sometimes these financial reporting exams can be quite daunting because you get all this information and you don't know what to do. If you can find a way to get a kind of simple task just to get your brain going, you'll find it makes it a lot easier on the exam. But let's look at what I've done. So I've actually done this. So if we look at that, we've added all these amounts together, right? So our revenue is 1,035, we've got a cost of sales, we've got a gross profit, right? Distribution, admin, profit before tax, and tax, just add together. And this gives us our profit per year from continuing operations of 358 for the parent and the subsidiary together. So, after we get this amount, we have to figure out what's attributable to who. So, we have the equity holder of the parent. So they get, this is their profit. So if we go back here, let's look. You see that their profit is 350. So they get that full 350. Alright? But they have a not wholly owned subsidiary, and that profit after tax, you can see here, is 8. Right? So they get 90% because they bought 90% of the share rights for that. So we add those two together, and that gives us a total profit for the parents of 357.2. Now we cannot forget the non-controlling interest. Right? So the non-controlling interest is 10%. Right, so they get 10% of the 8, 4.8. Right, and we need to make sure that it adds up to 350, so that it equals out. So after you've done that, you've basically done the consolidated statement of profit and loss, and you can give yourself a nice pat on the back. It's done, and then we can move on to other things. So don't be scared by the statement of profit and loss. It's a really simple, interesting way to get yourself going in consolidations. All right. So are there any questions before we go on? Bill's going to challenge me here with a nice question. Okay. Yeah, so it is quite weird when you see, because you know, just the terminology as well. So once you get used to the terminology, it makes it really easier to get it. But like I said, just really get to know your international financial reporting standards. You're not necessarily need to be an expert, all right? So if you will look at the tutorial notes and the guide, you will see the list of the international financial reporting standards that you're supposed to know. So it's not all of them. So you're not expected to be an expert in the international financial reporting standards. You're just expected to know the basics of what's involved in certain things, certain transactions. Okay, so there's the question. Oh, when do we call a company an associate? They're very good. So if a company owns less than 50% of another company, that is what's known as an associate. Now, if you get an associate, you do not cross-cast it, so you don't add everything up. All right, you just get a share of their profits. All right, we're actually going to look at that in another session. So basically, if it's less than 50%, all right, it's an associate. Now, there's more to it. All right, and we'll go into it in more depth. But basically, we don't have control of it. Right? So we're not controlled with it. So that's basically how we define an associate. So we'll look at the parameters together, all right? And we use what's called the equity method, all right? Which is a different method of counting. So it's basically we take what our investment is, and then we get our share of the profit, and then we show that in our statement of profit and loss and financial position. But we don't do any cross-casting because we don't control it. We only cross-cast when we control a company, so when we have more than 50% of the shares. All right, but very good question. All right, okay, very good. So thank you for attending this little module here. But we have to remember, as I've just said, consolidations are a very broad topic, and you do need to know quite a lot about them. So if you're interested in continuing your learning journey in consolidations and maybe get excited, because I like consolidations, I find them to be quite exciting, all right, just give us a call here at Osborne Training, and we can discuss the many options that we have available to help you become, really knowledgeable and succeed well on your exams. All right. So I'm available for any questions that you might have, and I will see you in a later module. Thank you very much.